yesterday we put out a note on REA on the we've upgraded our forecast and our valuation for this stock to reflect the acquisition of HomeTrack, which is a real estate data business, and also for the rising ad volumes that we're witnessing in our weekly count of ads on their site. The HomeTrack acquisition, it's a data service. It collects data on property transactions and then resells that data and valuation tools to banks at the moment. It doesn't have offerings for real estate agents and consumers and valuers, but it will expand into those areas once REA gets control of it, which is subject to ACCC approval. There's two aspects about this transaction I like. One is that just on its own, a standalone basis, its earnings per share accretive, but also at the moment they have to buy all this data from CoreLogic, which is a competitor. So not only is it earnings acquisition on a standalone basis, they're going to save several $1 million a year in data acquisition costs. So it's quite a value accretive deal. On the other aspect of the upgrade, last week Premier ad volumes around Australia were 44% higher than same time last year. So at the moment, there's a real rush of people at the top end of the market to try and sell $1 million plus properties, and that just plays straight into REA Group's strength. So second half of this year, they're going to have a great second half, and so our upgrade also incorporates an increase in our forecast for the second half of 2018, but we're not getting ahead of ourselves and being too bullish ahead of that. What that does, those changes to the valuation plus a roll forward of a valuation year means that our DCF valuation rises from 76.63 to 87.66, and so yeah, quite a big increase in valuation there. But we don't have wild assumptions about volume growth from FY19 forward, but certainly I don't think they're going to disappoint. So basically, after many years of having shrinking listings volumes, the volumes are running their way. So it looks like the trend's going to run in their favour for a while. Still got a hold on it. It's trading less than 10%, below our target price, so it doesn't trigger a buy recommendation. But certainly, if you own the stock, I certainly wouldn't be letting any go at these levels. On another stock in my coverage universe, carsales.com, we've had a much closer look at the Korean business, SK and CAR, that they acquired the other 50% of recently. We've spoken to former employees and other players in the Korean industry to get a better feeling for this business. Although Korea is a bigger car market than Australia, we certainly what we've concluded is the Korean advertising opportunity is not as big as it is in Australia, but certainly we expect NCAR to be achieving revenues of approximately 100 million Aussie within 5 years, and this will be quite a profitable business. The other thing that's going on with car sales is that their principal competitor is not really getting any traction with consumers. They don't have to spend quite as much money on marketing as we had feared, so we're lowering our marketing cost assumptions going forward due to lower competitive pressures. All of those factors, the career, changing our career forecast, but getting more confident there, lowering our ad spend in Australia. Our DCF valuation bumps up to $16.76, up from $15.43. And this business looks like it's going to have several really good years ahead of it. There's other upside that's not in our model, particularly in Latin America. They do have some early stage businesses there, which could become major earners long term. I think there's lots of growth optionality left in this business. So of the big three, it's the only one I've got an ad on at the moment. Our price target implies upside of about 13.5% from here. good business, well run, and I think yeah, it's worth adding to portfolios at this level.